Hey Samir, my first question to you is that after sharpest crash ever recorded in March, the stock markets are rising like crazy. Do you make sense of it?
Actually, it is a strange place to be in. There is total disconnect between the real economy and the stock markets. And it is not just in India, but it is happening worldwide. The euphoria in stocks is up against the bankruptcies and the unemployment in the real world. So it is a strange world, we know it, but it is not for the first time it has happened.
So, if it has happened earlier also, what has been the outcome of those events in general?
Almost every time the stock markets fell back to the fundamentals, which is real economy. So it falls back to its realistic valuation sooner or later. I think we need to acknowledge that the current disconnect between the financial markets and real economy is the wildest of all time. But again, as always, we expect that the market should come back to its intrinsic value sooner or later.
Okay, my next question to you is that where do you see the intrinsic value for Sensex?
Well, according to our calculations, Sensex between 28,000 to 30,000 level is a comfortable zone.
Would you then say that we should exit the market now and enter when it is at the right level?
No, I think that will be not appropriate. You should stick with your asset allocation model. However, if you are exposed to equity portfolio, in fact overweight on that, and don't have other liquid assets for next 1 to 2 years, then maybe you should try and reduce the equity exposure at current levels. And also, for those who are going through FOMO, now FOMO is like fear of missing out, then I would say that one should be cautious and patient with the money under current circumstances.
For every market rally, there have to be more buyers than sellers, right? So, who is driving the market at present? Is it institutions or HNIs or the retail investors?
Institutions and HNIs are playing very cautious. On the other hand, retail investors are very actively trading in the current market. New set of investors have thronged the market during lockdown. March 2020 was the best month of last 12 years in terms of new demat accounts opened. The retail investors trading volumes in the month of April and May on National Stock Exchange were up by 56% and 45% Y on Y. When I read foreign media, I read that in Singapore, retail investors are borrowing to invest in stock markets since the loans are available at very cheap rates, or near zero interest rates, and the stocks are available at substantial discounts to peak. In US, I read that retail investors are deploying surplus liquidity created by Fed into complex and dangerous derivative linked investments. Just yesterday, MarketWatch, which is a website, wrote that retail investors have simply forgotten the COVID-19 pandemic. They are in fact the most bullish set of investors in America.
So, when retail investors get bullish, we shall get cautious, right?
Yes, history suggests so. Retail investors are always late to enter in the cycle and at wrong time.
Thanks, Samir, and thanks to the audience. This sums up this topic. We will catch up with you later.